In our strategy, we look at markets through phases, not headlines. We focus on probability, sequencing, and what breaks first when conditions change. That matters because markets usually shift quietly before they move violently. Right now, markets look calm, but several signals suggest something is changing underneath. This matters because calm periods often end with sharp expansions in volatility. This is happening because positioning gets crowded, and when that happens, it usually leads to sudden repricing. The source video walks through intermarket shifts, dollar behavior, volatility compression, and silver stress. The message is not panic, but preparation. Our job is to translate those observations into phase probabilities and transmission paths. Directionally, leadership is rotating toward materials and energy. The magnitude is early but persistent, not just a one-day move. Historically, this type of rotation often appears near market turning points. This matters because indexes can hold up even while fragility builds underneath. This is happening because capital moves toward inflation-linked cash flows, and when that happens, breadth usually weakens. If this continues, high-concentration growth leaders tend to get hit first. That includes mega-cap tech and semiconductor-heavy exposure. This matters now because narrow leadership hides risk until volatility returns. Copper strength is diverging from oil weakness. If oil catches up, yields often move higher with it. Higher yields can pressure equities even if earnings stay strong. This is happening because energy feeds inflation expectations, and when that happens, rates usually rise. The dollar is sitting near long-term support with signs of a potential bottom. The risk is not a slow grind higher, but a fast move higher. Rapid dollar strength has historically pressured risk assets. This matters because global liquidity is dollar-based. When the dollar tightens quickly, markets often feel stress before headlines do. Equity volatility is extremely compressed across major indexes. This is the tightest setup in several years. Compression does not tell us direction, but it does tell us magnitude. This matters because expansions after compression tend to be fast. This is happening because options positioning suppresses movement, and when that breaks, price usually travels farther. If you find this kind of framework useful, this is exactly what we do every episode. We focus on helping you understand what matters before it shows up in price. Subscribing means you stay grounded in process instead of reacting to noise. Silver just experienced extreme volatility and a sharp reversal. That does not mean a final top, but it does signal reflexive behavior. When silver moves like this, something is usually happening in the system. This matters because stress often appears in corners of the market first. This is happening because leverage amplifies moves, and when that happens, shakeouts follow. More frequent options. Expirations are changing how markets behave. This increases hedging flows and short-term reflexivity. That matters because markets can look stable until they suddenly are not. This is happening because structural liquidity now resets more often. If volatility expands downward, concentrated leadership usually breaks first. Leveraged momentum strategies feel pressure early. This matters because index stability can vanish quickly once leaders roll over. We reduce fragility and protect optionality. We define exits before stress shows up. We keep dry powder so decisions are not forced later. This matters because flexibility is the real asset late in the cycle. Quick note, this is educational market analysis only. We are not giving advice or predictions. We focus on process, probabilities, and risk awareness. These signals increase the probability of a phase 2 environment. That is a phase where multiples compress and volatility rises. It is not a crash call, but it is a durability test. This matters because returns get harder while risk rises. Volatility compression now matters more as a timing signal. Dollar strength risk is more relevant at current levels. Silver behavior reinforces system sensitivity. We still wait for credit stress confirmation. We still ladder exposure instead of making all-in moves. We still treat cash as decision-making flexibility. Markets talk long before they move. This is happening because calm conditions breed leverage, and when that breaks, repricing follows. Our goal is not to predict the move, but to survive it well.